Thank you, Josh, for that kind intro, and afternoon, everyone. So I thought what I'd do this afternoon is talk about 10 monetary myths, or 10 monetary and financial myths, actually. Some of which will be familiar to all of you. One or two will perhaps be unfamiliar to everyone. Some of those myths are from the deep and distant past. Those myths have been dispelled again recently. And some of them are modern monetary myths that have yet to be fully dispelled. And I thought I'd talk about a little bit about both as the prelude to a conversation, a Q&A between us about some of the big issues here. And here's my one takeaway. If you remember nothing else about today's presentation, this is the bit to remember, which is, I'll say to you what I say to all of the new entrants to the Bank of England, which is that there has never been a time in recent history, possibly in human history, to be doing this sort of stuff than now. This is as good as it gets. When the new entrants to the Bank of England come in, I say, if you're not enjoying public policy now, leave. Go do something else. Because this genuinely is as good as it gets. This is as close as you will get to a clean sheet of paper when it comes to rethinking and when it comes to reframing the way we organise our economies, the way we organise our financial system, and indeed the way we organise our societies. This is a real opportunity. And the opportunity is not one for me. I'm far too old and grey. I hadn't realised I was been there for 30 years, Josh, but 30 years apparently at the Bank of England. It will be rethought and reframed by you. That is your endowment, and you could not wish for a better endowment than that one. So that's you can now all fall asleep if you like, but that is the key point to bear in mind as I wander through 10 monetary myths, starting with some old ones. By the way, as we go through, if you have questions, don't wait till the end. Just put your hand up. If it's making no sense at all, don't suffer in silence. Just say, Andy, what are you talking about? It won't be the first time that's been said, I promise you. So here's myth one. And it's an expression you may have come across. Who's come across this expression, which is kind of money is a veil, or banking is a veil? Anyone? One or two people?
I've just talked about it.
Okay. What? And only two put their hands up. So that'd be a worry for me, Josh, if I was you. Now, as put, and Josh has clearly already said a few words about it. As put, this is hard to make sense of, isn't it? It's effectively saying it does not much matter, be it money in our pockets or money in a commercial bank. It does not matter. It is a veil through which you look when making sense of what's really going on in the economy. But it has had its supporters over the years. Most recently, backing up maybe half a century or so, Milton Friedman, I'm sure is a name familiar to everyone in this room. The essence of monetarism, the essence of monetary orthodoxy, was that at least in the short run, at least in the long run rather, money and banking were something of a veil that could not durably affect the good things in life, like jobs, and growth and living standards. But even Friedman and subsequent acolytes in the neoclassical school would still contend that it was possible that in the shorter run, money and banking were not a veil. They were not neutral in their impact on jobs and living standards. In fact, they could have quite potent effects in the shorter term, particularly when money and banking was unstable. So in a way, this expression looks like a bit of a paper tiger. Who could possibly believe, not even Milton Friedman, that money and banking was a veil? And yet, when it came to as recently as 10 years ago, just before the dawning of the global financial crisis, you looked round academia, you looked round central banks, and this myth was very much alive and kicking. It was a struggle to find many universities that could bring themselves to teach a course on money and banking. They disappeared over the course of a decade or two. And if you moved from academia to central banks, you saw the same pattern. The models, the macroeconomic models, central banks, like the Bank of England, used to make sense of the world, themselves did not embody a recognizable banking sector or banking system. We were operating, trying to make sense of the economy with models that effectively treated money and banking as though it were a transparent veil, with no real impact on the fortunes and fluctuations of the wider economy, jobs and living standards. Of course, 10 years on, 10 years wiser, I hope we now all know better. And the reason, of course, we all know better is because we had a whopper, that's a technical expression, banking crisis, one as great as any we've seen since the 1930s. And guess what? It proved to be not a veil, to not be very neutral for jobs and living standards and levels of government debt. In fact, it had as dramatic an impact on those good things in life as any event you could conceivably imagine. This chart just scales. So here you have, let's take the left-hand side picture. As you look here, this is the sort of pre-crisis path of trend GDP, that's blue. And I've put on here the two biggest banking crises over the last 100 years, that associated with the Great Depression of 1929 and onwards, that's red, and the Great Recession of 2007, 2008, 2009, that's in green. The key takeaway there is that in both cases, as you all know, the loss of output, of GDP, cumulatively, has been gigantic. Almost as big, cumulatively, as the Great Depressions. In some countries, including the UK, it has been materially larger. In every European country, for example, the costs of the Great Recession have been cumulatively greater than the costs of the Great Depression of the 1930s. You could not pick an event in history outside war that had a more damaging impact on our long-run living standards. Another way of keeping score on the cost of this thing is not the GDP costs, but the fiscal costs, the costs to the public sector balance sheet of a banking crisis. The red and green lines here scale the change in the government debt GDP ratio that resulted from the Great Depression and the Great Recession. The key takeaway here is the cost to the public purse, green line, from the Great Recession has been materially larger than the Great Depression of the 1930s. And of course, these are the combined reasons why monetary policy globally, why central banks globally were forced to ride to the rescue. If output and jobs are crushed, and if the economy is facing a fiscal headwind to growth, we need monetary policy to step into the breach, to get output back to trend, and to support running the economy hot for a period. And that, in essence, has been the story of the last 10 years. That is why interest rates have been on the floor or close to it in every advanced country central bank. And that's why we've ladled on top of that a liberal sprinkling of this thing called quantitative easing, which in old money we called money printing, to augment the effects of lower interest rates. I will come back. Have you come across QE? Is QE, Josh mentioned QE? I'll come back to QE later on as another of my myths. So if anything were not to be neutral, if anything were to be not a veil, it was money and banking. That was a myth we should not have forgotten, but somehow managed to, just prior to the biggest hit to GDP and government sector balance sheets we'll probably see in our lifetimes. Lesson one, I hope, now learnt. Bank of England models now do have, surprise, surprise, you'll be pleased to hear, a banking sector in them, and the same is true of central bank models the world over. Money and banking, I hope, is being resurrected in universities across the country. It should never have got lost in the first place. So banking is inherently, always has been, always will be, a source of instability for the economy, for the government. Does that then mean government should step in and protect, regulate, restrict the banking system? Well, not necessarily. The pre-crisis orthodoxy was that financial markets could take care of this job, thanks very much, through their pricing of risk in the system. They could act as a private sector regulator of risk across the financial system. So if a bank or if a banking system was building up its balance sheet too quickly, taking too many bad bets on, that would raise the perceived riskiness of that bank. That would raise the cost of borrowing for that bank. And that would in turn constrict the amount of credit that bank could provide. There would be a counter-cyclical, leaning against the risk cycle mechanism operating within financial markets. If you like, the financial system would be self-regulatory. The pricing of risk would do the job on society's behalf. Did that happen in practice? Well, of course, it did not. And not even close. Not even close. So here's a measure of the cost of borrowing by the world's biggest banks, a measure of the extra spread over safe rates of return that banks had to borrow at. And the key point here is that at the same time as banks' balance sheets, banks were loading up on risk and expanding their balance sheets, there was not the remotest sign of that risk being priced by financial markets. If anything, the cost of borrowing was being lowered at the same time as risk was picking up. Financial markets didn't act to counter the risk cycle. They served instead to amplify the risk cycle by lowering the cost of borrowing for those institutions that were bearing the most risk. Right up until the point where they realized, when the balloon went up and everyone realized they were in crisis. At that point, look at the scale of the repricing. From roughly single basis points spreads to spreads up or around 200 basis points, a massive repricing after the fact. At just the time you wanted banks borrowing, in other words, in the midst of crisis, they were least able to, because the cost of borrowing had gone through the roof. deeply, deeply pro-cyclical, amplifying the cycle behavior within financial markets when it came to the pricing of risk and therefore the regulating of risk. This is not risk being regulated, this is risk being nourished. This is not risk being curbed, it is risk being amplified. So left to its own devices, financial markets did a spectacularly poor job of pricing risk in the banking system, as this picture attests. That begs the question, why? Why was it financial markets, and not just financial markets? I could add to the list of culprits academics, like Josh, blame him, central bankers, like Andy, that's me. I could include rating agencies, I could include institutional investors. It wasn't just financial markets missing it, it was pretty much everyone under the sun. This was a collective cognitive blind spot. A collective cognitive blind spot. And the question then is, what was the source of this blind spot? What did people get collectively wrong? What were the fallacies under which they were operating? And there's four I want to talk about, I suspect each of which Josh may have touched upon and indeed discussed in some length. Four fallacies that underpinned this radical underpricing of risk within the banking system. Here's the first one. The first one is that bigger banking, a bigger banking system, is a better banking system. What we saw in the run-up to the global financial crisis was that banking systems in lots of countries around the world, including the UK, US, France, Germany, pretty much everywhere, ballooned, genuinely ballooned in scale. The scale of banking assets relative to GDP went through the roof. And we told ourselves a story that this was good news, because this was greater amounts of financial intermediation. This was greater amounts of financial depth. And that in turn would nourish projects in the wider economy. It would increase households' capacity to borrow, to buy that house. It would increase companies' capacity to borrow, to buy that piece of plant or machinery or land or intellectual property. And that therefore nourished the wider economy in a way that was positive for growth. Indeed, we had evidence of that mechanism being in play. We'd seen lots of, in particular, emerging market and developing economies whose degree of financial depth had increased, and that it had in turn served as a springboard for improved growth and productivity in those economies. For them, bigger banking was better banking, because bigger banking meant higher growth in jobs, output, and living standards. But it turns out, we now know, that was only half the story. It was only half the story in the following sense, perhaps best demonstrated with this diagram, empirical scatterplot of the relationship along the x-axis. This is the scale of financial intermediation, if you like, bank assets relative to GDP in a selection of countries. And what I'm measuring vertically is some measure of productivity, output growth would do the job just as well. And the key takeaway is that you do indeed get this upwards path for certain countries up to a certain point. But there comes a point where you can have genuinely too much of a good thing, where the good thing in question is banking, where the net effect then is not to boost GDP and living standards, but instead to compress them, to reduce rates of growth in the good things in life. There's a number of reasons why this might be. Financial crises are one of them, but not the only one. It could be that when a financial sector comes of a certain size, it starts sucking the very best people into financial services and away from sectors where they may be more productive. How many rocket scientists pre-crisis stopped doing the science of rockets and started doing the science of financial instruments? Well, quite a few actually. That reallocation of labour may not have been the most efficient use of that labour in the wider economy. Now, what's true at the system-wide level, it turns out, we now know, is also not true at the level of an individual bank. Pre-crisis, we told ourselves a story, central banks, regulators, academics, rating agencies, investors, full house, that bigger banks were better banks. And we told ourselves a story for reasonable reasons, actually, and that's because a bigger bank had a bigger portfolio of assets, and that bigger portfolio gave rise to a greater amount of diversification benefits, as Josh was discussing, I think, before we came in. That was a reasonable point of view. As it turned out, even that bit was wrong, but it wasn't entirely unreasonable to think that by spreading your assets around, that would reduce the risk, the probability of that bank failing. Here's the bit, though, that's equally important, in fact, even more important when thinking about banking, which is not what is the chance of a bank failing, but what impact it has on society when it does fail. And that, we now know, is catastrophic. That is some multiple of the impact that an equivalent smaller bank would have if it fell. And the reason we know that is if we look at what governments felt compelled to do when those banks began to fail. They didn't let them fail. They couldn't afford to let them fail. They instead leapt to the rescue with hefty amounts of taxpayer support in one way, shape or form. This just gives a measure of the implicit subsidies given to UK banks during the course of the crisis. You'll see the big spikes in 08, 09 and 2010. These are huge amounts of transfers from the public sector balance sheet to the commercial banking balance sheet as recognition of this too big to fail problem. And of course, the too big to fail problem has its own circular loop, its own risk amplifying loop. If you think you are too big to fail, and if the market thinks you are too big to fail, it will charge you not a higher cost of borrowing, but a lower cost of borrowing, and therefore further amplify the risk cycle. And that is indeed exactly what happened in the run-up to and then the aftermath of the global financial crisis. Bigger was not better. Bigger came with a too big to fail subsidy and a huge collateral cost to the economy. Another feature of the myth, which I heard Josh mention as I came in, that was pervasive before the crisis and actually remains widespread even now, is about not size, but about complexity. A feature of these very big banks is that they are extraordinarily complex. extraordinarily complex. They operate in very many countries. They operate with very many business lines. Understanding the risk on these institutions' balance sheets is an incredibly difficult task. I would say almost impossible task, given the scale and scope of these big banks' business. Given that challenge, how do they do it? If you're the risk manager for a big bank, how do you go about that gargantuan complexity task? Well, we told ourselves this is a place where the appliance of science, where technology, where modelling could really help. The way to understand, get underneath the skin of risks on the balance sheet was to model them. To model them in microscopic detail. To assign a price, what we call a risk weight, to pretty much every asset on the balance sheet. Millions and millions of asset classes, each of which had its own price, its own risk weight, generated from some very complex models developed by the banks. Did those models do a good job of measuring risk? What does anyone think? No. Terrible. Absolutely appalling. For a number of reasons, one of which was that they were based on incredibly short runs of data often. Sometimes runs of data that didn't even include a crisis in them. There was a famous, did you mention the Goldman Sachs chief risk officer quote, Josh, in any of your presentations?
No.
You didn't? Well, this is the one, he now claims he never said this, but he definitely did. Which was, it was just in the height of the financial crisis, and he said, we've run our risk models, and what they tell us is that we are currently experiencing levels of risk that are 24 standard deviation events, several days in succession. Now, if you do the maths on that, that's really quite unlikely. You know, you'd expect one draw on one day of that scale to occur, you know, once every several histories of the universe, right? The chance of that happening on successive days, I mean, it's many, 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 many multiples of the number of atoms in the universe. So that's so one possibility is that. The other is that the models were total nonsense. And which do you think? And that was by no means an unusual modelling outcome. This is not at all Goldman Sachs specific. In some ways even worse, to sort of compound the felony, it wasn't just banks using these models, it was regulators as well. Those risk weights I mentioned, those prices of risk from models were used by regulators the world over to figure out how much capital, how much equity banks should hold as contingency against a future bad loan or bad shock. So-called risk-weighted capital ratios used banks' own models to figure out how much rainy day equity should be set aside. And surprise, surprise, those risk-based measures of capital did a spectacularly poor job of predicting those banks that did well and those banks that didn't. This picture speaks to that. So that's the myth number 5, that complex finance implies complex models and complex regulation. And here's a demonstration of it. So this is each block here is a bank, red and blue. What's shown in both cases is a measure of the equity in those banks, measured in two ways. On the left-hand side is one that uses those complex risk weights from models that I mentioned to do it. On the right-hand side, this does not use a model, or if it does, it's a very simple model. It assigns a weight of 1 to every asset. Okay? Simplest conceivable model of weighting the risks in your assets. So that would mean a government security and a complex derivative have the same weight. Sounds lunacy, right? Why would anyone do that? Nonetheless, if you compare these cheek by jowl, same set of banks, different measures of capital, this one using complex models, this one using the simplest imaginable, simplistic weighting scheme. The reds here are banks that failed. The blues are banks that survived the crisis. For this, there is no relationship whatsoever between the measure of risk or capital and failure. It's a toin cost, basically. This one, the simplest imaginable weighting scheme, what's called the leverage ratio, by the way, does a much better job. Many more reds for those banks whose leverage ratios were particularly low. This discriminates, good and bad. This does not. Even though this is meant to be pricing risk, and this one's falling over itself not to do so. This is an example, another one, of the risk models not just getting it wrong, but giving a thoroughly misleading signal of risk in the system. This is an example of a more general feature, more general property that's been discovered in all manner of different risk environments, which is the following. What is the right response to tackling a very complex adaptive system? Well, the intuitive response is that you fight complexity with complexity, right? A complex system requires complex regulation to keep it in check. But it turns out, most of the time, that intuition is completely wrong. That the most robust way of dealing with a complex system is to apply simplicity. For the same reason you don't fight fire with fire, you don't fight complexity with complexity. Otherwise, you get complexity squared, which is a lot worse. All sorts of examples of this in practice. Let me give you one. So, who's heard of Harry Markowitz? Anyone? Harry Markowitz, you have. Harry Markowitz, together with Bob Merton, the architect of modern portfolio theory, basically. So, Merton Markowitz, their framework for thinking, tells us that when we're choosing a portfolio of assets, we need to take into account both the return characteristics of the asset and the risk characteristics. The efficient portfolio trades off risk and return. For that, they rightly won a Nobel Prize. It's the bedrock of almost everything we do, in life as well as in finance. And yet, when Harry Markowitz retired, and it came to choices about his pension, how do you think he chose his pension assets? Risk return, anyone? The principle on which he won a Nobel Prize? Absolutely no way. He weighted them all equally like this. He followed a 1 over n rule, where n's the number of assets. He chose the simplest possible rule because it was the most robust to not knowing. In a paper I gave at Jackson Hole, which is basically a central banking shindig in America a few years ago now, I spoke a bit about this, about the case for simplicity in regulation. And I used as my example then, not just Harry Markowitz and his pension choice, but the example was, and you may have seen it, it was in your background reading, I think, of a dog catching a frisbee. So the idea here is as follows. If you think about, if you try and write down frisbee catching as a mathematical problem, it's extraordinarily, I can send you the reference actually, on the mathematics of frisbee catching, because it's a strange object. You know, you've got to take account, you know, air, temperature, air pressure, angle of trajectory, and if you solve that in the same way as Goldman Sachs was solving its risk problems, it would take you a long time, even if you're really smart like they are. But it's interesting to look at how people catch frisbees in practice. Because most of us aren't solving that very complex Newtonian problem when we catch a frisbee. We don't do that, and neither do dogs. So dogs are brilliant at catching frisbee. So the average sheepdog is much better than you and me, and everyone, not just you, by the way. I'm sure you're great, but the average sheepdog is much better. The answer to the question, why is the sheepdog better at catching a frisbee than I am? Because I've been taught a bit of Newtonian physics, and the sheepdog almost certainly has not. And yet it's better. How does it do it? Well, it catches it in the same way as we all catch a ball, actually, in the air. So a ball goes up in the air. You're playing, how many English people here? Cricket. Americans? None. Okay. Anyone play baseball? Anyway, any ball. Throw a ball in the air, and you're trying to catch it. You're running to catch the ball. What is the rule of thumb we use to catch the ball? Well, let me tell you. We use a heuristic, a rule of thumb, and it's called the gaze heuristic. And that means we run in a direction that means that our angle of gaze to the ball is constant over time, right? And what that means is we don't run optimally. We don't run in a straight line. If the ball's going to land there, right, I don't run to that spot in a straight line. I run in a curve. We're in a curve so that the angle of gaze is constant over time. That maximizes my chances. This is going somewhere, by the way, don't worry. I'll bring it back. The angle of gaze is constant over time. That's what we use when catching a ball, and that is the way that a dog catches it runs in a parabola. You can write this down mathematically, and I've done this actually. It runs in a parabola like this, you're watching. Like this, an angle such that you arrive at just the right point in a way that maximizes the chances of catch. And that is basically how we all go about solving the most complex of problems. We simplify it down to a rule of thumb, a heuristic that works. In this case, the simplest possible heuristic, which is that our angle of gaze will be constant, in the same way as our risk weight is constant in different sorts of environments. And most of the time, this works perfectly. Let me demonstrate. Here's a video of a dog. So you're going to throw the frisbee. Watch the angle the dog runs. Where is the dog? You can see the dog in a minute. I will press it again. You see, it's going to run in a parabola, right? Angle of gaze, and then it will jump at exactly the right time, such that it catches the frisbee, and you'll all applaud. Ready? Here it goes. So here we go. Here it goes. So slow it down now. Watch. Now watch. Goes off. See off the right. So angle of gaze. See in a parabola. Now coming round. Gets his type. Jumps. And misses. See, it doesn't always work. The look on the face, brother, the look on the face of the dog is absolutely classic. So those rules are almost always robust. Occasionally not. Final fallacy, pre-crisis fallacy, was that financial integration is always and everywhere a good thing for us. When it comes to financial system stability. This was a very strongly held prevailing pre-crisis myth, as it turned out. Not an unreasonable one. It was said that by joining up the world, we could disperse risk to the four winds. Yeah. A risk that was out of sight was out of mind. It was scattered around and diversified away. A more joined up world was a more stable world. Risk was spread. Risk was diversified. And once again, as on many things, there is more than a grain of truth to this proposition. The only problem is, it is only half true. It's only true half the time. It is true, except in those situations when it's not true. It turns out those second sets of situations are actually rather important. So financial integration is in fact a double-edged sword. It is both good and bad cholesterol. It is a source of stability, but it is also a source of fragility. It is one and the same. Let me demonstrate this. This is a little, this is more complex than it looks. It's a little, by the way, this just makes clear the scale of the pickup in financial integration over the last 150 years or so. It's been amazing. So the blue here, what do we got? The pink is financial, and the blue is trade. And the scale of the pink is on the right-hand side. And this makes clear that the integration of goods and services flows globally has been that's been a big pickup over the last century and a half. But the pickup of the scale of financial integration is really off the map. It's been enormous. A much more financially joined up world, a genuine global financial web. Is that a good thing for stability or a bad thing for stability? Well, it turns out that it's both. This makes clear why. Slightly complex 3D chart, which are hard to make sense of, I realise. Let me try and navigate you through it. So measuring vertically, I've got a measure of risk in the system. Think of it as the number of banks going bust, where yellow is none and red is everyone, basically. Okay, so the size of the hill scales the size of the risk to the system. Measuring along here, we have a measure of the strength of the banks. How much equity capital they have on their balance sheet? How big is their capital ratio? So moving this way means stronger, safer banks. And then finally, the third dimension, measured depth-wise, is a measure of the degree of joined-upness of this web. How joined up is the financial web? Higher numbers mean greater degrees of joined-upness. So imagine now you're experiencing a situation where the world is becoming more joined up. Okay? Most of the time, that is quite a good thing. You are sitting in this yellow zone, the zone of tranquility. And that's the zone where risk dispersion, risk diversification, the scattering of risk to the four winds is happening. And that's a good thing for the stability of the system. This much of the story is true. The problem comes, though, when something big and nasty comes along, like a global financial crisis, the sort of thing that eats up the amount of equity that banks have. What you find then is you can suddenly flip from the yellow zone of tranquility to the red zone of fragility. Why is that? Why is that? Because all of a sudden, risk sharing becomes risk spreading. All of a sudden, a problem shared is not a problem halved, it's a problem doubled. It's a problem that spreads around the global web. And it spreads further and it spreads faster precisely because that web is more closely interconnected. This is a feature of every web you could possibly conceive of, whether social or natural or physical. It's called the robust yet fragile property of connected webs. The more connected a web, the greater degree of knife-edgeness in its stability. A bigger zone of tranquility, but a simultaneously greater zone of fragility as well. As good contagion becomes bad contagion. As a risk shared becomes a risk doubled. And it was that second part of the equation that risk models and regulators and academics failed to fully appreciate. And that's why we found ourselves at the top of the hill in 2009. More myths. In response to this, what did regulators do? Well, understandably, predictably, they tried to right some of those wrongs, including by requiring banks to hold larger slugs of equity, what's called bank capital. And of course, many banks were not very pleased about this. Here's the progress we've made, by the way. This looks at the capital ratios, the equity ratios of some of the biggest banks and the liquid asset ratios of those banks. They've picked up quite a lot. A lot has been done by regulators, and I was once one, to get banks having more in the tank for a rainy day. Capital ratios of banks have in some cases more than doubled, and that is good news. This has not been a painless exercise. The banks in general have not thanked the regulators for their troubles. They have complained repeatedly that capital is being set at too high levels. Now, what's certainly true is that capital is being set at higher levels than it was pre-crisis. But does that mean too high? Well, there's no simple, single answer to that. But here's a historical metric on just whether these levels are indeed high. This looks at capital ratios and liquidity ratios for UK and US banks over a much longer time period. Let's take the left-hand side picture, which is takes us back to the over 100 years, back to the end of the 19th century. You'll see back then, see the pickup in capital most recently, but this still leaves it less than half the levels it was at the start of the 20th century. So by any historical metric, capital is higher than in the past, and that's a good thing, but by no means high, at least by historic standards. Now, one reason banks are so averse to higher ratios of equity, higher capital ratios, is because they say that can damage their capacity to lend. That higher slugs of equity borrowing raise the cost of capital for them, and that constricts their capacity to lend. That's the argument. Is there any support for that in the data? Well, we have a natural experiment after the global financial crisis, which was, are those banks that were subject to higher capital ratios, did they lend less afterwards? And the short answer to that is no. The short answer is the exact opposite, actually, as you might expect. Those banks with higher levels of capital were better able to lend in the immediate aftermath of the crisis. They had more fuel in the tank. They had larger rainy day reserves. And that gave them greater confidence to lend to businesses and to households after a big shock came along. So far from being a source of constricting credit, higher capital, higher rainy day reserves are the thing that can help preserve credit and lending in situations of stress, the sort of situations, of course, for which bank capital was designed. How am I doing time-wise here, Josh?
A couple more minutes.
Yeah, and I'll shut up. Last two myths, and the last one is more an open question. But here's one I should really cover, because I know that Josh mentioned he'd covered QE. People have very strongly held views about QE. There's been lots of it, let's be clear. So in this country, the Bank of England, my institution, bought almost £500 billion worth of assets. Actually, I'm on the board of directors that looks after that. You should try be on the board of directors of a company with assets of £500 billion. It is frightening. But globally, what, 12, 13 trillion pounds of assets were bought by central banks, US, Euro area, Bank of Japan and elsewhere. A lot of money in the system. And of course, the purpose of that QE was to support the economy, but the mechanism by which it supported the economy was, at least in part, by boosting asset prices. And that's caused a lot of people to be quite upset about the adverse consequences that QE might have had, in particular for inequality. By raising asset prices, has this not made the rich even richer at the expense of those that were asset poor? In fact, on QE and on lower interest rates, as central banks, we sometimes find ourselves being run over in both directions. So older generations that were relying on their savings, for example in banks, they said, you are killing us with lower interest rates. We are getting no money on our bank deposits. And then younger people said, you are killing us with your QE. That is making the older people so much richer, whereas we haven't even got to buy a house yet, and it's going to cost us even more in future because of your actions. So both old and young, rich and poor, were up in arms about QE. Was that justified? No. Now, you expect me to say that, wouldn't you? But it's actually backed up. I have gone through, this is such an acute point, such a sensitive point. We and others have gone through this in microscopic detail, household by household, balance sheet by balance sheet, and asked the question, how has QE affected you? How has it affected your income? How has it affected your wealth? How has it affected your happiness? I've even measured happiness household by household and asked whether QE makes people happy. And the good news is, it does. It does. So here's, I'll not show you happiness, but I will show you income and wealth. This is broken down by age group. I could cut it any which way. So you do get you understand some of the complaints. So if you're an older household, your income is lower as a result of lower interest rates. If you're a borrower and young, you're in the money. If you're older and a saver, you are out of the money. The wealth pattern, in some ways, is the flip of that. If you are older with assets, you have done better than if you're younger without. But the key takeaway, if you take both together, or indeed just take some measure of well-being, is that almost everyone, with the exception of maybe less than 10%, maybe 5% of people, have been made better off in financial and non-financial terms as a result of QE. And the main reason why they don't perceive this, of course, is because people don't perceive the main reason why QE has worked, which has been putting people in jobs. Right? You can observe the direct effect of QE, or lower interest rates, higher wealth or lower income. What they don't observe directly is the effect QE has had in generating extra jobs. Without QE, without me having bought £500 billion of assets, not just me, but me and my institution, there would have been between 500,000 and 750,000 more people in this country without a job. Right? That's what we're talking about. Guess what? That's bad news. That's bad news for them. Now, they're not sitting around saying, I got that job because of the nice Bank of England, by and large. They think it was down to their good luck or skills, and in some cases it was. But without our dose of monetary medicine, those people and others besides would have been materially worse off. That's what this calculus does. So whatever you read and hear in the press pretty much daily about how pernicious QE has been in worsening inequality, don't believe a word of it. Read my paper on the topic instead. It's not only made you wealthier, but happier too. Tell your parents this evening, you are all happier as a result of Andy's actions at the Bank of England. Now I should stop. This was my final slide, which is the work in hand, the work to be done. I've given some examples of stuff we might discuss, but actually rather than me going through this, why don't I take some questions from you about what you would like to talk about on any of this stuff or indeed anything else.
Thanks very much, Andy.